What's up? What's up? This is Jamarcus Traham, and this is Money Mondays, episode 5. Right? I'm gonna start a little series about money circulation. Right? So you understand how this money is circulated around. Right? Or you can understand the economy. All right? The economy is the circulation of money in a particular entity. Right? So we're gonna understand the economy because I'm gonna teach a little bit about how money circulates. All right? So today I'm going to give you a basic lesson about interest rates and how you get a certain interest rate for whatever you're trying to borrow money on. All right? So let's get started. All right? Everything always starts with the government goal. Right? You might not think, you're like, what the government got to do with my mortgage? What the government got to do with my car note? Everything. Right? Their goal is to either get you to buy more or to pull money out the system so people can buy less. That's inflation and that's deflation, right? So the government has direct power to inflate the economy, to blow it up like a balloon. They also have the power to deflate the economy, to pull money out of the system, right? And I'll show you how. All right? So sometimes their goal is, man, we got to keep the unemployment rate down, right? Man, we got to keep job growth coming up. Man, we got to keep the GDP growing. We got to keep the country growing, right? The GDP is gross domestic product. It's just a fancy word for all the products and all the services in the country added together, right? So if that's their goal, sometimes they got to inflate the economy. Sometimes they got to blow the balloon up. They got to put more money into the economy to blow it up, to keep job growth up, right? So if their goal is inflation, which it is right now because of the coronavirus, it's scaring them and they don't want to slow up the economy because if you slow up, you'll get a recession and depression and stuff. So their goal is to inflate the economy. Boom. Send everybody $1,200. There's $75,000 or less, right? Let's keep the economy going. They don't want you to save that money. They want you to spend that money so they can keep the economy going. Matter of fact, if you want another $1,200, all everybody got to do is, if everybody just saved the $1,200, the government would have to send another $1,200 because that goal wasn't for you to save it. It was for you to spend it. It was for you to stimulate the economy, right? So they do purposefully, they inflate the economy on purpose. They put trillions of dollars into the economy, right? Now let me show you how this affects you. If the goal is inflation, which normally during bad times, they want to inflate the economy so they can keep it going. All right, so the government tells the feds, hey, man, we gotta inflate the economy, right? The Federal Reserve is not in the government, but it works with the government, right? Now, the Federal Reserve turns around and sets the interest rate. The interest rate is the base rate for the entire country. So all the other loans in this country have something to do with this base rate that the Federal Reserve sets, right? So if they're trying to inflate the economy, if they want the economy to move, they'll charge you low interest, right? Again, interest is a charge for borrowing money. How much you got to pay because you want to borrow some money, right? So if they want to get stuff pumping and get stuff moving, what they're going to do then is, man, the feds drop the rate down to 0. That's real cheap money. 0% interest or 0.5% interest. That's real cheap, right? The only problem is you ain't paying the federal base rate. The banks are. The credit unions are. So they pass that cheap money on to them, right? So if the Federal Reserve want to put more money in the economy, they want to make people get more loans, they drop the interest rate. Boom, the interest rate 0. Now the banks say, okay, well, that's cheap money being able to be loaned out. So we can loan out money at 1, 2, 3, 4, 5%. It doesn't matter because the interest rate is so low. So, right? So then they can turn around and make a whole bunch of loans. The banks and the credit unions can give money to other banks. Like if a bank is smaller and they can't particularly get the money from the Federal Reserve, then a big bank can loan money to the smaller bank. Right? See, everything is interconnected. The whole money supply, the whole circulation, right? That's why it's easy to collapse as well, because everything's all tied together. right? Now, they can take that cheap money and say, okay, I'm going to lend some to a smaller bank, or personally, I can give it out to individuals via credit cards from banks, personal loans from banks. Those are unsecured, which means they don't have nothing backing them, right? Or they can give out secured loans like auto loans and mortgages, right? Which have collateral tied to them, the house or the car, right? Now, normally your unsecured mortgages, your unsecured loans are higher, 15+%. Your secured loans, 3 to 5%, but that also has to do with you personally. See, nothing else affects you until you get over here from the bank. So the bank has a certain interest rate that they have to be above, right? Because you got to be above the base rate or they ain't going to make no money. So if the base rate is 0%, that's good. So any interest that they charge you, they're going to make some money, right? So right here, the better your credit is, the closer you're going to be to the base rate, right? If the interest rate is 1%, for the base rate for the whole country, and you get a 2%, 2.5, that means your credit is good. You're really, really close to the base rate. But if your interest rate is 5%, 6%, and the interest rate in the country is 0 or 1, that means your credit is not that good. You're not that close to the actual base rate. The closer you are to the federal interest rate, that means your credit is good, right? And that means the bank is not going to make that much money off of you, right? See, they tend to raise your interest rate because, number one, to make money off people, and also, number two, to cover risk. So the riskier you are, the higher your interest rate is going to be off from the base rate, right? Now, when they inflate the economy, when they blow the balloon up, they put all this air into the system, right? Not only did they give people the money, they also decreased the interest rate with the hopes that banks going to lend out a whole bunch of money to people too, to keep everything moving, right? A bank might give money to a business owner, like that loan they're giving out, their small business loan and all that. They want you to hire people. They want you to pay for rent, pay for utilities, all of that to keep everything going, right? So to inflate is to put a whole bunch of money in the system to keep everything going. Now, to deflate is the opposite. It's to pull money out the system. You say, they pull money out the system. The first time I ever realized the government pulled money out the system is dead presidents. When they was burning the money up, and they was like, why they burn the money up? Because the government needs to take that physical money out of the system, right? Well, they don't have to burn the money up anyway. That was in the 80s and 90s. Now they can just not lend as much money out, or they can raise the rate. Because if this rate rises, then they going to have to raise their rate up, and if their rate go too high, ain't nobody going to be borrowing money on credit cards or car notes or mortgages because it's too high. I can't afford it. I can't afford to pay it back. So the government can control the money supply simply by telling the Federal Reserve what they're trying to do, and the Fed will set that interest rate for the entire country. That can either spark people to speed up, or it could get people to slow down because it's too high and they can't afford it, right? So you ask yourself, hey, Jamarcus, how does that affect me? What this got to do with me? Well, since we're in coronavirus, we're in a period of inflation because the government is pumping trillions of dollars into the economy because they're trying to stop a recession from coming, a depression from coming. So let's just give out as much money as we can, and with the hopes of everybody spending it so we can just keep the economy going, right? So they also dropped the interest rate down. The interest rate right now is 0, right? Which means you have a lot of cheap money. So if you're in position to buy a house right now, take advantage. Hopefully you got good credit so you can be close to that cheap interest rate of 0, right? Or if you already had a house, you already had a car, but your interest rate was higher, now is the time to take advantage of that low base rate and go refinance your house, refinance your car loan for a cheaper rate. Now, that's assuming that you can. That's assuming that you still have your job. I know a lot of people are unemployed right now. But if you still got your job and you still got a good source of income, look at your interest rates on the money that you borrow. And since you have cheap money in the system right now, use that cheap money to refinance your house, your car, and lock it in at a lower rate. That way you can save money on your monthly mortgage and your monthly car note. Right? Again, this is Jay with the NBA on Instagram. I'm Jamarcus Traham, and this is Money Mondays, episode 5. This is about money circulation.